Hello, and you're welcome to Global Business Insights, where we cover details on the main stories from the business perspective. The French government will buy strategic assets of the heavily indebted technology company Atos as Paris keeps part of the business in national hands. They include supercalculators for quantum computing used by the army for the country's nuclear weapons program, secure communications technology also used by the military, and certain cybersecurity assets. President Bola Tinubu yesterday justified removal of full subsidy by the federal government, as well as efforts currently being made to manage Nigeria's foreign exchange market. He was speaking at the opening of a two-day special World Economic Forum in Riyadh, Saudi Arabia, where he has secured a $600 million investment in seaport infrastructure from Danish shipping company AP Moller Maersk. The Dow Jones pushed up with all the other major indexes as investors shook off still sticky US personal consumption expenditure price index inflation. Markets closed in positive territory on Friday, and as we speak, futures are in positive territory as well. Markets still see a 44% chance of at least two rate cuts from the US Federal Reserve this year, with 60% chance of a first rate cut coming in September. However, there are quite a few that just see one cut later in the year, and some are even talking of no cut at all. Also yesterday, Borja Brandi, president of the World Economic Forum, at a special meeting on global collaboration, growth and energy for development in Riyadh, Saudi Arabia, warned that global debt ratios are close to levels not seen since the 1820s, and there was a real stagflation risk for advanced economies. He added that the greatest risk for the global economy is now the geopolitical recession that we seem to be faced with. Bob Bakish is expected to resign anytime from now as Paramount Global CEO amid merger talks heating up with Skydance. Paramount Global and Skydance Media are moving closer to a merger combining the two media companies. Skydance Media and its private equity backers KKR and Redbird Capital Partners are reported to be targeting May for finalizing terms of the arrangement. And Tesla Chief Executive Officer Elon Musk made an unannounced trip to China yesterday and met Premier Li Qiang. Slowing EV sales is prompting cost-cutting drive and the reduction of more than 10% of its global workforce and other challenges Musk is facing, even as he seeks for approval for full self-driving or FSD capabilities in Beijing, where he's seen some headwinds both from competition and from regulation. The capabilities have been banned from widespread use, while other rival automakers such as Xpeng are gaining advantage rapidly over Tesla by having better government support in rolling out similar software. It all comes to data and where the data is going to be kept, and if China can allow data to leave Beijing. The recurring theme on the mind of businesses who want to stay ahead could be how to build resilience in light of the tougher external context. And this cuts across the continents in a situation where none are immune to the impact of external developments in an increasingly more integrated global economy. When you compound uncertain geopolitics with structurally higher cost pressures, interest rates, and all the macroeconomic volatility, you could find operating models, assumptions now obsolete, and the need to rethink dimensions of doing business to stay competitive and profitable becomes imperative. According to a study by Analysts Data Services and Resources, that's in Nigeria, on the resilience of Nigerian firms over the global financial crisis of 2007 to 2009, the 2016 recession, and the COVID-19 pandemic in 2020. Businesses in the financial and industrial sectors were the most vulnerable, while the agriculture and trading sectors were more resilient. But as global integration interlocks more Nigerian corporates with international supply partners, the future environment presents more vulnerabilities than the past. In its latest study on the topic, Accenture concludes that after decades of cheap liquidity combined with low and stable inflation, they see a fundamentally different era where supply scarcity is set to become the main driver of economic outcomes. This will, however, create opportunities for those able to build resilience against these pressures, thus gaining competitive advantage. The next 5 to 10 years could be years of tighter supply in credit and liquidity, labor and energy and commodities. Accenture also sees a trend of growing trade frictions and retreat from globalization, constraining access to key factor inputs. And the fragmentation of global production and trade is eroding the previously low friction flow of labor, of goods and services, energy and finance around the world. The result will be margin erosion, volatility of input costs, inflation of course, and intensifying financial and market valuation pressures. All this on top of more complex supply chain management challenges with more potential points of failure. Now, what can companies do differently? Starting afresh with fundamental cost reinvention to fortify the business model against margin erosion becomes a good idea. They can also consider new levers like artificial intelligence, robotics, and automation, as many are already doing, to push up productivity in a difficult time. Companies also need a plan to navigate the growing labor supply pressures and skills gaps as the war for talent intensifies. Companies may also want to explore improving government relations capabilities and industry partnership frameworks to leverage government support for onshoring, nearshoring of production and supply. In the new environment, governments are playing a bigger role to create jobs and economic growth. Already, global markets are separating winners from losers and interpreting narratives on the basis of how companies are able to defend themselves, also at a time when balance sheet buffers and fundamentals are also becoming more important for price valuations.
Concerning the question of the subsidy removal, there's no doubt that it was a necessary action for my country not to go bankrupt. One, to reset the economy and the pathway to growth. It is going to be difficult, but the hallmark of leadership is taking difficult decisions at the time it ought to be taken decisively. That was necessary for the country. Yes, there will be blowback. There is expectation that the difficulty in it will be felt by a greater number of the people. But once, I believe it was their interest that is the focus of the government, it is easier to manage and explain the difficulties. Along the line, there is a parallel arrangement to really cushion the effect of the subsidy removal on the vulnerable population of the country. We share the pain across board. We cannot but include those who are very vulnerable. Luckily, we have a very vibrant, youthful population interested in discoveries by themselves and highly ready for technology, good education, committed to growth. We were able to manage that and partition the economic drawback and the fallout of the subsidy removal. Equally, it engendered transparency, accountability, and physical discipline for the country.
Nigeria is doing almost everything in the IMF rulebook on subsidies, more driven by proximity to bankruptcy than any other factor. Removing subsidies definitely creates fiscal space for better targeted social spending, reductions in inefficient taxes, and productive investments, which will promote sustainable and fairer outcomes. Fossil fuel subsidy removal can also reduce energy insecurity concerns related to volatile fossil fuel supplies, as better prices attract investments, especially in the era of energy shortage. My take on producer subsidies is that productivity improvements and removing barriers to competition are absolutely critical as we remove subsidies so that already impoverished populations are not paying extra for inefficiency, for unnecessary cost overloads and wasteful governance, poor decisions and structures which are passed on into cost of energy, electricity or other inputs. Pushing subsidies without addressing productivity and governance reform places unjust burdens on the population, which they have no reason to bear, and often could be the root cause of all the societal pushback to subsidies, which of course potentially leads to a higher risk of policy reversal.
Capital formation that is necessary to drive the economy, like agriculture, food security, innovation, technology advancement, must be an inclusive program of the entire world. No one should be left behind.
On capital formation, the president is spot on. No country should be left behind in capital flows in terms of having enough to develop their own economies, rather than the situation we see now where less developed economies are penalized with high risk ratings. Others are now talking about canvassing for debt forgiveness as reparations for past centuries of exploitation. But we must also admit that while there is some capital that can move to address inclusivity or even reparations, most capital will always be attracted to economic efficiencies, decent yields, good governance, macroeconomic stability, and plugged leakages, rule of law, and order. Meanwhile, some good news as Nigeria secures a $600 million investment in seaport infrastructure from Danish shipping company Moller Maersk on Sunday. This was secured after a meeting between President Bola Tinubu and Moller Maersk chairman Robert Maersk Ugla on the sidelines of the World Economic Forum meeting in Saudi Arabia. And we also are seeing Japan's yen falling further against the dollar. The Japanese stock exchange are closed for holiday. Hong Kong equities continue to climb following last week's pledges from China to preserve the city's role as an international financial center. This is Bode or Shosami. Please share and kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. That's it from me on Global Business Insights. Thank you very much for watching and